All right, well, I know we might have some more people jumping on, but we're going to go ahead and get started out of respect of everyone's time. So for those of you who don't know me, my name is Nicole Schaefer, and I'm the director of Her Traditions here at Traditions Bank. And as part of our focus on continuing financial health education, we are so happy to provide events like this, where as women, we can get together and have open conversations about concerns in our life. And I know that this topic is one that is near and dear to so many of us as we try and navigate what are next steps, not only for ourselves, but for our parents, for our grandparents. So kudos to all of you for being part of this conversation. And the biggest thank you, of course, goes to our friends at RBC Wealth Management, who go above and beyond to be true partners with Her Traditions. Emily Sides, who is an advisor with the firm, is always reaching out to me with ideas and different ways that we can invest in women's financial health. So I want to give her a sincere thanks and turn things over to her so that she can introduce today's speaker.
Yes, thank you for the lovely introduction, Nicole. A partnership goes two ways, though. So you and the bank have been such a great place to work with, and I'm just so thankful that this partnership has really blossomed into something wonderful over especially the last couple of years. So excited to be here. If you don't know who I am, I'm Emily Sides with the Sides Group at RBC. I'm a financial advisor on the team here. I'm one of 5 advisors on our team here, but I'll leave it at that. We didn't come on here to talk about myself. I am going to introduce you to our speaker. I've known Adele for a couple years now, really since I started in the industry, and she is a wealth of knowledge. She has over 20 years of experience in the financial services industry and really focuses on insurance and life insurance. That's really her expertise. So we kind of brought her on here today to talk about planning for the unexpected. And I know she's going to do an excellent job of really going into detail about what that really means and give us some really good information on this topic today. She is, as I mentioned, she is a wealth of knowledge. She has what we like to call in our industry alphabet soup behind her name. She has so many designations. She is a certified financial planner. She is a chartered life underwriter. She has a certification in long-term care, and she is also an accredited estate planner. Adele, if I missed something, I apologize on all of that. Hopefully I hit it all. But I will turn it over to you to get started. If you don't hit on it, Adele, I'll mention it quickly here. You can ask questions. So please, if you have any questions that come up, you are able to ask questions throughout the presentation, at the end of the presentation. So write them down, and we're happy to have a discussion after the presentation is over on anything you'd like to bring up. So please keep this interactive. We're happy to do so. So go ahead, Adele, take it away.
Thank you. Well, thank you, Emily, for such the kind introduction, and Nicole for having us all here today. And just to reiterate Emily's point, we really want to make the best use of everyone's time who's joined here. So please do feel free to ask questions during the presentation, only because of background noise. It might be better to use the chat feature. So if you just hover over the screen at the bottom, you'll see a little chat button. I'll be monitoring that as we go through the presentation. And I'm also planning on staying on after and happy to talk to anybody or have any questions answered then. And of course, if you'd like to have an individual conversation about your own specific questions or your own specific situation, we're always happy to make ourselves available. And you can do that through Nicole and Emily as well. So I'm going to go ahead and get started and share my screen. The goal of this presentation is kind of give you some ideas about what is out there in the marketplace, some risks to your retirement that you might want to think about, and some ways you can safely mitigate those risks. And when I mean safely, and not have to possibly sacrifice some of your bigger picture goals in retirement. So there is an intersection. Oh, why is this not forwarding? Here we go. There is an intersection between what we say health and wealth. So we want you to have a happy, healthy retirement. We want you to enjoy all those things that you've worked so hard to accomplish and over the years and people that are strong savers and put money away and sacrifices you might have made to get to the point you are today. But we also want to make sure that your financial situation is healthy and that you are protecting yourself where you can from some possible expenses that may derail those goals in the future. And as women, one of the biggest possible expenses that could come into play is the need for long-term care. Women are 45% more likely to need and use care. And I'll get to the need and use in a minute, because there is a difference between needing it and actually using it. And 2/3 of all new Alzheimer's diagnosis are women. We outlive our male counterparts by on average of about 5 years. So, for this group and Nicole, for the group at the bank, the Her Traditions group that really focuses on women's issues, I think this is a great conversation to have. And there are all various different ways that you can kind of integrate thinking about this risk into your plan. So we're going to talk about some of the risks in retirement, like we talked about long-term care, how you can plan for the unexpected, some things to really think about when you're, being realistic about, what retirement might look like and what planning you might want to do. And then we'll talk about some options to cover that risk of long-term care, or needing long-term care rather. So if we look at the different pieces of retirement, one of the biggest risks, or one risk, is longevity, right? We outlive our money. And RBC does a great job with a tool they call a wealth plan that can help you look at your assets, where they are, what you kind of spending you think you might do, what kind of returns you might get in the market based on your investment tolerance and your risk tolerance. And they can kind of tell you, okay, here's where we think that your likelihood is of being able to live comfortably in retirement. Here's some changes you might need to make to your portfolio or your spending, so on and so forth. But they can really help you determine, what is the likelihood that I'm going to outlive my money? And I've worked with clients that have $1 million of assets and $100 million of assets. And ironically, the fear of outliving their money is real between both of those subsets of clients and everything in the middle. So, it's a very rational concern for clients of all wealth levels. So, there is a 63% chance that a couple in good health today will live to at least age 90. And that number is extending annually as we do things like have medical advancements, and we, take care of our diet, and we exercise, and all of those things, right? The longer you live, the more likely you are to live longer. So your life expectancy, while it gets shorter in number of years as you get older, it does get longer in terms of, when I'm 65, my life expectancy, might be 90. When I'm 85, if I'm in good health, now my life expectancy might be 93. So, keep that in mind. There is still today over 1/3 of a chance that one of a couple will live to age 95, and 10% of people will live to over 100. So interesting to think about. I work with clients more and more nowadays who will say, well, my grandma lived to this, or my mom lived to that, or I'm celebrating my dad's 99th birthday. So longevity is definitely a real risk to retirement when we look at how long those assets have to live, or how long those assets have to maintain your living. Inflation, we've heard a lot about inflation, especially recently. I heard on the radio yesterday that the inflation is so far as 8%, one of the highest inflation rates that we've ever had, at least in recent history. So obviously we know that $25,000 today is not $25,000 in the future, right? The goods and services that we can purchase with that money, with that amount, today versus in the future is very different. I heard on the radio this morning that housing is up 20% from where it was this time last year. So that means if you were to move, the house that you were looking at last year is going to cost you 20% more than it did a year ago. That is huge. So something to keep in mind as well. Obviously, we're not going to be in an 8% inflationary environment forever, God willing, because then we all have a lot of things that we need to talk to our financial planners about. But it just shows you, even with an average of 3%, you got to think about the value of my assets now Am I going to be changing my investment strategy because I'm getting older and maybe I'm more conservative? And how much beyond inflation will I now earn to make up for that? So these are just things that everybody needs to think about as they get older. Sequence of returns, obviously, right? So we've seen some volatility in the market recently. And if you have a longer time horizon or some time to kind of make up for some of those losses, maybe that doesn't impact you so much. But if you're living off of a fixed income or you're getting ready to retire and you need your assets to kind of maintain your lifestyle and you have a 5% or a 10% correction in the market, that could be, very a big impact into your overall plan. So these are all things that, are just everyday life risks that we all have to take into consideration when we're thinking about the future. And then, of course, healthcare. Anybody who has had any sort of health issues, or even when you pay for health insurance, Medicare, so on and so forth, we all know that healthcare is one of the highest cost items when we look at our spending, especially as we get older. And if we are not fortunate to have a pension or have worked for maybe a government entity or something like that, where health insurance and so forth is included in part of our retirement package, healthcare can be extremely expensive. And this is not talking about even long-term care. This is talking about going to the doctor, prescription medications. What if I have to have surgery? What if I need to have a hip replacement, so on and so forth. So long-term care does fall under healthcare from an insurance standpoint because it's regulated by the same regulatory agency that covers health insurance. But long-term care does not talk about things like medical procedures, doctor's visits, prescription drugs, and so forth. So again, these are all things that when you're working with your financial planner, your team at RBC, we're going to look at as, okay, you want to get to X, you want to retire, you want to spend a certain amount of money. How can we mitigate some of these risks, or how can we account for some of these risks in your overall plan? One risk we didn't talk about is taxes. We all pay those for sure. I just paid mine yesterday. Was not a fun day. So, the other thing that we have to think about is the nature of our assets. We have qualified and non-qualified. So qualified, many of you are familiar with 401ks, IRAs, things that you've been encouraged to do at work with pre-tax dollars, which are great vehicles. And yes, you should do all those things. But remember, pre-tax going in, income taxable coming out. So if I have $1 million IRA, and the tax rate goes up to 40%, now I really have a $600,000 IRA, right? Because every dollar I take out, I gotta pay taxes on. So that's another risk of tax rates going up, down, left, right. Who knows where they're going to be, but that's something else to factor in retirement. So as far as misconceptions, this says perceptions, but we'll say misconceptions in retirement, these are the biggest things in these little bubbles that we hear from clients. What will Medicare cover if I need long-term care? So we'll touch on that. I don't want to be a burden to a family member. I don't want to have to move in with my son or daughter. I don't want to, have to have them pay for my care. Long-term care insurance is too expensive. I can't afford it anyway. People who can afford it don't need it, and the people who need it can't afford it. Health insurance rates, are they ever going to stop increasing? Are we ever going to have health insurance reform? So on and so forth. And what are my options if I do need care? About 80% of the clients that we talk to, that RBC works with, when we do a wealth plan and we list, there's a couple things you can list as a concern. Over 80% of people pick funding a long-term care need, or funding the cost of needing long-term care. But of those 80%, only 56% have researched what that would cost, how we can mitigate that risk, and what we can do to protect those. And of those 56% that actually have talked about it or thought about it, half of those people are actually underestimating the potential cost of care. And we'll go into that as well. The thing about long-term care is, it's a little bit of a guess, right? I had 4 grandparents, as we all do. You'll remember from the first slide, about 70% of people will need some type of care. Doesn't mean you're ever going to go into a nursing home, but that means at some point, someone's going to have to help you with 2 of the 6 activities of daily living in your lifetime. And I had 4 grandparents. My grandfather on my father's side passed away of an acute heart attack at age 67, never needed any care. His wife, my paternal grandmother, lived in an assisted living facility with Alzheimer's for 9 years. And this goes back 20 years ago when it was a group home. We don't have like the Marriott type luxury assisted livings that we had back then, or that we have now. And even then the cost was over $8,000 a month. And that was 25 years ago. My grandparents on my mother's side, my grandfather went from working full-time to passing away from kidney failure in 2 years. Any long-term care he would have received probably would have been end-of-life hospice. And my grandma on my grandfather or my mom's side lived with my mother for 15 years. And passed away 5 days short of her 94th birthday. She had a stroke. And she lived with my mom for 15 years, and her need for care got aggressively higher. She moved in, she needed nothing. Then she needed a little bit more help here. Then she wasn't comfortable showering or bathing by herself. So we needed an aide to make sure she had help there. Then she really couldn't get dressed because she couldn't do buttons and she was just getting frail. So we had to, have the aide come in a little bit more, and so on and so forth. So I have experienced kind of all ends of the spectrum of care. And with long-term care, you don't know which one of those 4 people you're going to be. You kind of hope you're the person that goes peacefully in your sleep and never needs care, bothers anybody, etc. But the likelihood of that happening, especially as women, you'll notice both of my grandmothers lived very long. The likelihood of that happening is probably not high. So something to think about there. So while this is not something that we really love talking about, right? There's much other better things in retirement we want to talk about, like travel and trips and grandchildren and all those things. Just some basic statistics. So we talked about 70% of people over the age of 65 will need some type of care. That could be, I have a client who's 67, had 12-hour back surgery, needed care for 6 months. He's back at work, he's golfing, he's fine. Right? But he needed some care for 6 months. He never was confined to a nursing home. He was working that whole time, but he couldn't transfer, which is getting from a seated position to a standing position or out of bed without assistance because he couldn't twist and stand up. So he needed help with that. And he was a fall risk in the shower. That's a long-term care event. In our area, the Baltimore area, the median cost, this is middle cost, of a private room in a nursing home, because who wants to have a roommate when you're 80? Certainly not me. I don't want to have a roommate now. Is about $153,000 a year after taxes. So think about if a family member or somebody is going to be responsible for helping pay for care, how much do you have to earn to then pay the government taxes to then walk away with $153,000, right? What would the impact of paying $153,000 a year out of your retirement portfolio be on your overall portfolio? Now, granted, if you were paying $153,000 a year in a nursing home, you sold your primary residence, you're not paying a mortgage, there's travel expenses and stuff that you were accounting for. You're probably not traveling. Other expenses have probably gone down, but it's still a pretty hefty bill. And that is not for luxury assisted living or in-home care. And most clients we work with would prefer to stay at home as long as possible. The average length of stay in a nursing home is 2.5 years. And, Emily and I, as she mentioned, have worked together a really long time. And we get this question all the time. Well, how long am I going to probably need this? And the answer is, I have no idea. There's so much informal caregiving given by family members. Example, my grandma lived with my mom for 15 years. She probably had some type of care, maybe minimal, then more for the last 10 years of that. She never stepped foot in a nursing home. So her average stay in a nursing home was 0 years, right? But it did not mean that she wasn't getting care by a family member at home prior to that. So because there's so much informal caregiving and family caregiving, there's just the statistics around how long people really need this or how long claims really last are really quite flawed. Even looking at, well, what's the average claim? Well, the average claim for a long-term care need only counts people that have long-term care insurance. right? So the people that don't have long-term care insurance never made a claim. I will tell you, I have a friend whose mom lived at home with 2 round-the-clock aides for 10 years. She was diagnosed with dementia at 72. The longest long-term care claim that is being paid and is still being paid is 14 years. So again, trying to plan around, how much am I going to use, or what's it going to cost, or how long am I going to need this is kind of a futile effort because we have no idea. And so we'll talk about kind of how with not knowing how to plan and how not having that information, there are some ways that you can still plan and you can kind of narrow down what you want to do. This is just a kind of an idea of some basic costs of care in the various areas. I'm in Baltimore, not too far from most of you. So we just kind of picked that as kind of a suburban, relatively close area. But there is a website, and I'm happy to share that with Emily and Nicole, and they can share it with you. It's a consumer approved website. You don't need to put your information in. No creepy insurance person is going to try to solicit you or call you. You just click on a link and you can look at the different cost of care everywhere in the country. So if you say, well, we're retiring to Alabama because it's way warmer and things are way cheaper down there, that is true. But you can put in any zip code that you like, and you can see what the average cost of care is for a private room in a nursing home, an adult daycare assisted living facility, hourly rates for home care. And you can look at them today. And there's also a scale that you can slide up and say, well, when I'm 80, 85, that's really where this is going to come into play, right? So I don't really care about what the cost is today. I want to know in the future what we might be looking at. And it will just tell you, hey, if you need to stay in a nursing home, this is what it costs a year. We don't know if you'll be there a year or 10 years, but this is what it costs. Here's the average hourly rate for home care, et cetera. So if you really kind of want to get a handle on what is the risk, that's a good website to use. And this just kind of shows you the various options for needing care. One of the things I will tell you is we all have homeowners insurance, I would assume. And I can put a dollar amount on my house, right? I know what my furniture costs. I know, all of us at this stage in our life, we've probably all been through a kitchen remodel and a bathroom remodel and all those fun things. So we kind of know, okay, if I needed to redo my kitchen, if I needed to redo my bathroom, if I had a house fire and, my house was claimed a total loss and I needed to rebuild this property and I needed to replace my clothes and my furniture and all those things, forget the priceless stuff, the pictures and the memories, all that's priceless. But the hard assets of my home, I can put a finite dollar amount on that and pretty much figure, maybe not to the penny, but let's put it within 10%, maybe 15% of what it would cost me to do all that. If I told you you had a 70% chance of having some type of damage to your home, a fire, a flood, maybe you wouldn't destroy the house completely, but maybe you'd have to move out or for a couple months or what have you. If I told you there was a 70% chance that something like that was going to happen, I would argue that most people would make sure they have really good homeowners insurance and that it's paid up and it's enforced, et cetera. With long-term care, that expense could be completely unknown. We have no idea what the cost could be. So I would really encourage you, whether it involves insurance or not, to understand the level of risk there and not to scare you, but to really be realistic and think about, okay, we need to figure out if we do have this big event, are we okay? Can our assets cover it? Do we not want to have our assets cover it, et cetera? So when you're thinking about the risk, really kind of think about it that way. And then we talk about family care. Remember, I said that a lot of care is given informally, right? By family members and so forth. So a lot of times now we all work remote for most part. I'm at my home. You talk about the Great Resignation. You've had people moving. Oh, I can live in Dallas now and still keep my job in Baltimore because, they'll let me work remote, whatever. So do we have a lot of situations where parents and children don't live so close to each other anymore? Now, I happen to live 30 minutes from my mom, but that's a big situation. So if you think about your kids might be more than willing and happy and have the means to help you, but if they're in Dallas and you're in Boston or you've retired to Alabama, how does that really work? Do you move? Do they move? What is the impact on both of your lifestyles for making that happen? The second bubble here, a lot of what we do with planning has nothing to do with money. It has to do with keeping the family intact in case of a need. We all have examples, and I'm sure many of you have examples in your personal life of situations where brother, sister didn't agree on how mom or dad should be taken care of or what kind of money should be spent, et cetera. And it's caused a major rift in the family. So that's another thing, planning for this and having a plan, no matter what that plan is, and saying, hey, your advisor saying to your kids, mom and dad already talked about this. This is what they wanted to have happen. We've set aside these assets, or they wanted us to spend this, or we have this long-term care policy, or fill in the blank, can really eliminate some of those risks of just family discord. Paying for care. We talked about financial commitments, income, is there taxability in what you're using to pay for care, et cetera. And then will it disrupt your overall financial plan? And it won't, as long as you plan for it, right? So we want to make sure it's included in there. So this is a piece that RBC put out, which is really helpful. Again, 75% of caregivers are women. We care for aging parents, we care for husbands, and so forth. So the burden of care, not only are we more likely to need and use care, but we're also the ones that end up being the caregiving. We talked about 70% of people over age 65 will need some type of care. We talked about the fact that 2/3 of all new Alzheimer's dementia or Alzheimer's diagnosis are women. Alzheimer's is a form of dementia. Dementia is the overarching diagnosis, and then Alzheimer's is one of the forms. And so we know that's very expensive because it results in a long claim, and normally a claim that requires round the clock or at least 12-hour-a-day care. So these are all statistics, a little bit repetitive, but that we think about. And again, we want to talk about what is the impact of caregiving on myself, my family members, and my assets. So there's a lot of different options to pay for care. I just want to look at the chat and make sure that there's no questions. So there's a lot of different ways that you can pay for long-term care, the need, not insurance. So you could pay out of pocket. You could say, we've got plenty of assets, and if we need to move in a facility that's $200,000 a year because we want to go to the best facility possible, then we have the money to do so, and we'll cover that risk when we get there. Totally acceptable answer, as long as you understand what the potential cost would be, and what the risk is to your assets. You could use things like a home equity line. You could use a reverse mortgage. RBC has what they call a CAL, a credit access line. Now that all depends on the value of those assets, right? I can take a home equity line if I have equity in my home. Okay, so that's kind of a crapshoot. Yes, I could sell my home. I don't know what the value would be this year. Maybe it's 20% more than it was last year, but we all know how bubbles work. And when they burst, things can go the opposite way. So that's, you have some risk there, right? Of what the value of those assets were going to be. You can depend on the government. Medicare will pay for the first 100 days of care only. And that is if you are likely to improve, your situation is likely to improve. So if you fall and break your hip and you are likely to get better and eventually come home, Medicare may pay for the first 100 days of care. If you have a stroke and 30 days in, you have not regained use of your right side, you have not regained use of speech, Medicare will say, Medicare is not for palliative or long-term needs. It's a temporary need to help get you recovered and back on your feet. They will not cover the cost of care. And actually, if you look at your recent Social Security statement or you go online and download it, the back page will say, Medicare is not intended to cover the need for long-term care, and you are encouraged to look at options privately insured. Okay. Medicaid would cover you. So Medicare, we talked about Medicaid aid, will cover you if you have no assets. So you must spend down pretty much all of your assets and basically be a ward of the state in that sense. It really is a welfare program. And Medicaid will tell you where you will be going. So for example, in the state of Pennsylvania, if you live in York and your family lives in York, but the nearest bed is Altoona, you're going to Altoona if you want Medicaid. So you are basically at the mercy of the government. It is considered welfare, and you would have had to spend down all your assets. So anybody that has, you know, I would say an average or maybe above average amount of assets, the likelihood is you don't want to qualify for Medicaid, and you're likely not going to because you have too many assets that you'd have to spend first in order to even qualify. Medicaid is really a program for you know, people without means. And rightfully so. I mean, it's good that there are programs out there for people that need it, but it is not for people that are looking to do a financial plan and have retirement assets and so forth. It is really not a solution for care. There are a couple states that have FILAL laws. I never say that word correctly, so I might have said it wrong. It's a very odd word to me, but what that means is children are held legally responsible if a parent cannot pay. So you move into an assisted living facility, you're there a lot longer than you thought, and you run out of assets. They could hold in 30 states, and the states that are listed here. Pennsylvania is one of them. Maryland is one of them. Delaware is one of them. These are all states that kind of are in our little area here. West Virginia, Virginia. They could hold the children responsible for those bills. So something else to kind of think about there as a family unit. The other way to pay for the need for care is insurance. So long-term care insurance, there are many, many, many different flavors out there that will fit kind of everybody's various needs. You could buy a traditional long-term care policy that's just designed to cover long-term care. Think of it like homeowners or car insurance, no claim, no benefit, right? No accident, no claim. So I either, you know, pay premium and get a benefit if I need it, or I paid premium for no benefit. We really don't look at those products much anymore, just because there's more innovative products on the market now. And the biggest negative of that particular product is your rates are not guaranteed. So you could have increases in rates in the future. And when we work with clients, as Emily knows, one of the biggest things we hear is, oh, my parents had a long-term care policy, and gosh, I mean, they paid so much in premium by the time they were done. They never even got what they paid back in a claim. Or my dad had long-term care, and by the time he qualified, he was so sick that he passed away 3 months later. It was worthless. All of those issues, and they were issues with older products, have been cleaned up, I guess is the right word, with the newer products that are on the market today. So the triggering is much more consistent between all different products. In order to go on claim, you have to not be able to perform 2 of 6 activities of daily living. Those activities are defined as bathing, eating, dressing, toileting, continence, and transferring. We talked about transferring, getting from a seated position to a standing position, getting in and out of a chair without assistance. My grandpa, had one of those like kind of ortho lift chairs, help him kind of get out. So you can't do 2 of 6 of those. And your condition is lasting 90 days or more. So notice, you don't have to be completely incapacitated, never to recover, completely disabled. 2 of 6 activities for 90 days or more. I use, again, the example of my client who had back surgery and then went back to golfing. So it doesn't have to be that you're never going to recover. Doesn't have to be that your condition is permanent. The other way to trigger claim is so it's 2 of 6 activities, or you have a severe cognitive impairment that requires substantial supervision. So anybody on the call who's dealt with a family member that has had Alzheimer's, dementia, et cetera, you probably recognize that physically they can be the healthiest people there. My friend who I mentioned, whose mom had dementia for 10 years, she never had any physical health problems, but she could not be left alone because she was a definite risk, to her safety. So you can't do 2 of 6 activities, or you have a severe cognitive impairment that requires supervision, substantial supervision. So those are the ways that you can go on claim and access your benefits. And that's the same with all of these products. The other option is life insurance with a long-term care rider. So you buy a life insurance policy, and you might say, well, at this stage in my life, I really don't need life insurance. That is likely true. But the reason you're buying the life insurance is because it's giving you a product that will have a guaranteed premium. So you don't have to worry about the premium increasing. And it eliminates that use or lose, where if I don't need benefits, if I never go on claim, I'm one of those 30% of people that never has an issue. Your beneficiary will get your death benefit. All the unused long-term care benefits will be paid out to them as a tax-free death benefit. So it's just a way to eliminate that use or lose type situation. And then we have asset-based long-term care, which is kind of a combination of the two. It gives you a long-term care benefit with a smaller life insurance element. So it still will alleviate that use or lose type issue. And then of course, there's other things that you can do, which have nothing to do with kind of leveraging assets or protecting assets, but are good parts of planning. Healthcare directives, power of attorney. I just had, my parents did all of that. I did that myself. Many of you might not be aware, although if you've had kids going off to college recently, you probably had to deal with this, that if you have a medical incident and your kids come and want to talk to the doctor, because of something called HIPAA, right? We go to the doctor and we sign our name, and immediately as we sign our name, the receptionist looks at it and puts a big black mark through it, right? So no one can see that we were at the doctor. Because of HIPAA, what they can release is very limited. So having those healthcare directives, having those power of attorney directives, having those things in place for when you need them, just like long-term care, unfortunately, many times when those decisions have to be made, you might not be the one making them. They might be being made on your behalf. So it's really important that beyond long-term care and insurance and all of that, that you do have the proper documents in place for the future. Especially as we get older and just, we are going to probably have to rely on help from friends or family members. So just a reminder, we don't offer tax or legal advice. We're more than happy to help you with, what the taxation types of may be on different assets. And one of the benefits of long-term care insurance itself is it is income tax free. So if I'm getting $10,000 a month for my long-term care policy, I do not pay tax on that. So just again, another way that kind of shows the leverage there. These two pieces are RBC Wealth Management pieces that I'm sure Emily can follow up with, whoever's interested. This financial impact of dementia piece is a great one. It is a long one. It is a long piece, but it has a lot of really, really good information in there. And we did take a lot of this presentation from that as well. And then thank you all sincerely for allowing me to join you today. I hope it was a good use of your time. I'm happy to stay on and answer any questions. If you would like to put it in the chat box, I will not share my screen for privacy's sake. So if anybody wants to put something in the chat box and I don't have to say who it came from, I can just a general question that you want to ask and be anonymous. I'm happy to do that. If anybody would like to unmute and raise their hand or clear their throat so I know they have a question, I'm happy to do that as well. And Nicole and Emily, if you have any follow-up questions or if there was anything you wanted to make sure I covered today that I did not, I'm always happy to do that too.
Yeah, I'll start. Adele, this was fantastic. So thank you for all of this information. Not the most exciting or happy topic to talk about, but definitely important. It is something that I don't think we talk about enough. And it's one of those things where hindsight is always 20/20. And if you run into a situation where you need to be a caregiver or figure out how to have your parents be cared for, what if I'd have done this 10 years ago or 20 years ago? How would this have changed the situation and the outcome? So I think that this just needs to be talked about more to be able to prevent those situations where we're looking back thinking, what could I have done differently to make our outcome a little bit better for our family? Two quick questions for you, and I have more if no one else has other questions. But my first question is, where does someone start? So if they've never had maybe they don't even have an advisor, but this is something that they want to look into. Do they start having a conversation with their siblings and their family, figuring out what's important to them, how much care can they provide for their parents? Where does someone start if maybe they don't have an advisor? If they do have an advisor, I can speak from my own personal experience. Come to your advisor. We're happy to give guidance and have a conversation, but where does someone start?
I think the best place to start, and I think, not to sound, weird, and Glenn, I see you on here, so just earmuffs on this. I think women are very good at being realistic and agnostic and proactive, in my experience. And just kind of sitting down and thinking about the reality of the situation. I can't tell you how many times advisors come to me and say, my wife wanted me to talk to you about this. My wife wanted me to ask you about long-term care. My wife is really concerned about this. She's really thinking about this. I don't think we need it. I think she's ridiculous. I think she's overreacting, but she really wanted me to talk about this. And notice he didn't say to her, oh, you're overreact, right? He still came to me and asked the question. So I think it's just having sitting down and thinking about whether it's with your spouse, or if you're not married or don't have a spouse, with a friend or something like that. And just really kind of thinking about, okay, this is something I need to think about. What do I want to do about it? Do I feel comfortable everybody's risk tolerance a little different. Do I feel comfortable saying, hey, I'm pretty comfortable with my assets. I know what I have and how it works. And I'm pretty comfortable. I know my spending, that if something happened, I could take care of it. I know it's going to sound like a little bit of a plug, and it's really not. Working with an advisor, just like anything else, if I wanted to, where do I start if I want to think about moving? Well, I might play around on Zillow or something like that, right? But at some point, I need to talk to a realtor, or I need to go talk to a mortgage specialist and figure out what I can qualify for and what the rates are and what my monthly cost is going to be. So, just kind of thinking about if it's something that matters to you and that you want to tackle, and then reaching out and finding somebody who can guide you through that process, I think is really, really important. Insurance, I obviously sell insurance for a living. That's what I do. But insurance is not the end all be all. And I tell clients all the time, whatever decision you make, as long as you made it with all the facts and you feel comfortable with that decision, that's all that matters. It's a judgment-free zone, right? We just want our clients to feel comfortable, to understand where they are, to understand what the risks are, to take whatever steps they're comfortable mitigating those risks. And then we're happy. If we have happy clients who feel like, I'm really glad we had this conversation, I understand that I'm going to self-insure and this is how, great, that's fine. So, but just really sitting down and kind of thinking about, close your eyes and think, what would happen if, God forbid, tomorrow, and we had this happen to a client, I missed a step and broke my ankle. She needed care for 9 months. She's single. What do? Do you start calling home care services and saying, oh my God, I need you to come move into my house for 9 months? Do you call a child who lives close who can come and help you? Do you move in with your son and his family for 6 months? These are things that you kind of got to think about. What happens if something does happen to me?
And
I don't know if that answered your question, but I hope it did, Emily.
It did, yes. And to kind of piggyback on that, is there a sweet spot in age where it's time to really start looking at if they want to buy some sort of life insurance policy or long-term care policy? Is there a sweet spot in age that is appropriate for a husband and a wife or an individual to start looking at products, or is it never too early, never too late?
Well, it really is never too early for sure. What we do is we look at different types of products based on different ages and situations and so forth. So for example, I talked about traditional long-term care very abstractly because it's not guaranteed and it's use or lose. But if I have a male in their 70s, that might actually be the best product for them versus a couple in their 60s where they could have this product, God willing, for 25 years. And that leads them to a lot of rate increase exposure. So I probably wouldn't recommend that for them. The benefit is of doing this planning sooner than later is, unless you all have some secret I don't know about, none of us are getting any younger, and more likely we're not getting any healthier. So these eligibility classification and rates are based on your age and your medical background. So, so no time like the present as far as, our age and our health and so forth. But we get a lot of people that are like, I really want to do this planning, but, I still have kids in college or that are going to go through college. And that's a big expense. And I'm not sure how to deal with that and so forth. And it might be, hey, there's some things we can put in place as a stopgap, but then we can come back to the table with other planning. So it's really never too early to start. the only problem that you get is if it's too late because of age or underwriting. And I do have somebody just asked that in the chat, what age do you get long-term care insurance? So hopefully we covered that as well. You know, and we always say the day before you become uninsurable, right? But we never know when that day is going to be. So, and then somebody else asked, I am type 1 diabetic. How does that affect my ability to get long-term care or life insurance? What we normally do if we have a medical situation, so RBC and our firm are completely agnostic, meaning we represent 30 companies. We don't work for an insurance company. We don't represent an insurance company. We represent you, the consumer, to the marketplace. So what we would do is we would get some history, background on your situation with the diabetes. We look at A1C, and are you in control, you know, is your blood sugar controlled? You regular visits to the doctor, height and weight, any other issues that might be going on. We take that to our internal underwriter at our firm, who will then anonymously go out to all of the insurance companies. And actually have one of my desks give me an Excel spreadsheet like this that says, okay, here's what all the companies said. Go figure out of all these companies, which has the best product. And then I go in and say, okay, well, based on what the underwriter said, here's what the costs are. Here's the different products that are available. Let's talk about if it makes sense or not within your plan. Those are the only 2 questions I have so far in the chat, Emily. So if you have any others, or Nicole, if you have others, feel free to ask away.
Yeah, I have one just because I'm curious. Have you seen more and more people having conversations about this since COVID has happened? Have you seen more people have more interest in wanting to have some sort of policy in place because COVID has happened, or has it kind of been the same?
You know, we've seen a little bit more of it only because we've had people that, you know, are concerned about their parents. I actually had a client who, you know, during the first year of COVID 2020, you know, obviously didn't see anybody, especially if you had older parents, you might not have wanted to see them, right? Because we didn't have vaccine and we were nervous and all those things. And I actually had a client call me at probably January this year and said, I hadn't really spent time with my parents in a year. I saw them for Christmas this first time, and I was shocked at the difference from either being in isolation or just being gone for a year. Like, it was really quite concerning, and we need to talk about if they're, you know, eligible for something, and we need to do some planning. So, so I don't think the COVID conversation has sparked it. It definitely has sparked people calling me and asking if their life insurance is in force and things like that. You know, but I think that with families, you know, kind of not being together and then kind of getting back together, it's definitely, you know, kind of, I think we've had some people notice there's been a definite change. Now, I will tell you too, that during COVID, the carriers really did restrict their underwriting. So they made it a lot more restrictive to get coverage. But many of those carriers have now released those restrictions. So we're kind of back to where we were pre-COVID from an underwriting standpoint. I just got a message in the chat. I work in non-medical home care, and we see a spike in the request for services around the holidays for that exact reason. So, so yeah. Because I'm assuming you mean that you've seen a spike around the holidays because people go spend the holidays with their parents and they're like, oh my God, I got to get somebody in here. Yeah, she said yes. Right. So that is something, you know, to kind of think about, especially this, you know, nowadays when, you know, people are very remote. She said, we are super busy today, actually. I wonder if that's a function of spring break and families getting together and now coming home and going, oh no, we need to figure something out. Oh, she said, yeah, there we go. So anyway, so yeah, so that is something that we do see. And that's a really good point too. You know, we always ask clients, oh, you know, now do you expect any inheritance or something like that? But we don't a lot of times do a good job of asking clients, what about your parents? You know, I could go to Emily and say, okay, Emily, here's my 401k and I'm putting this much away and I make this much money and I think I'm going to spend X in retirement. And she could say, oh, you're in great shape. But if I left out the fact that my mom's a single mother and worked her whole life to raise 2 kids and couldn't put money into her pension until both of her kids graduated from college because she couldn't afford to, and doesn't have a lot of assets, and if something happens, I'm going to have to cover half of that cost with my brother, and so my expenses just went up by $50,000 or $60,000 or $100,000 a year. You know, we don't talk about that. So we do see a lot of adult children coming together and saying, hey, brothers, sisters, listen, if something happens to mom or dad, like we're going to be on the hook for that. So maybe we should come together and look at funding something for them and paying, that will pay or offset the cost of care. So we do see that quite a bit. And so that is something that's quite viable, if that's your family situation. I'm getting a lot of thank yous. You're all very welcome. Thank you for attending today.
Adele, I did have a question too. I've had concerns from people reaching out about this subject that their worry was that the care wouldn't be covered. They thought that, if they wanted to go to a particular facility or, use a specific provider, and they would be restricted. Could you speak on that a bit?
Yeah, so most of the time you do have to go to a qualified facility or use a qualified provider. However, a lot of the products we work with now are called indemnity, meaning once you trigger that 2 of 6 activities of daily living, as long as you have a plan of care, because they want to make sure that this money is not being allocated to something other than your own care or being redirected or something like that. They'll give you your money and you can kind of use it for whatever you want. There are other products out there that are reimbursement products, meaning I pay for care, in a accredited facility or using a licensed home care agency or what have you, and they will reimburse me. In my experience, we have not seen claims denied because you didn't use the right service or the right provider. The biggest time we've had claims denied is you go make a claim and your doctor says you're not going to need care for 90 days. You're going to be good to go in a month. And that is really the definition of long-term. 90 days doesn't sound that long, but that is what the long-term and long-term care is. So for the most part, if you meet those 2 of 6 activities of daily living and you're using a licensed, legitimate facility, even if you have reimbursement, it's really not an issue. If you have indemnity, you definitely get a lot more flexibility. And most of the products on the market we work with today are indemnity based, not reimbursement. So it does give you more flexibility. If you want to, some will let you pay a family member, which, people think that's great. If I have to move in with my daughter, I can pay her. But I would argue you're probably better off taking that money and paying somebody to take care of you, because I know my grandmother felt like a burden to my mother, and my mother never made her feel that way. That was her own internal feeling, and she would have much rather paid somebody whose job it was to take care of her. Giving that money to my mom would not have made her feel any better. You know what I mean? Like but there are companies that will allow that and give you more flexibility with how you can spend the benefits. I don't have any other questions in the chat. I'm happy to take any others. Again, anybody, if you would like to talk offline about your own specific situation or talk about some planning for you, let Nicole know, let Emily know. They'll loop me in where appropriate, and I'm happy to talk about anything you want to talk about.
Yeah, I'll just chime in here to wrap some things up, and Nicole, feel free to wrap some things up as well. I don't have any other questions. I do have other questions, but we would end up being on here all day long. So I think what we've covered has been really great. I know even from my side of things, being an advisor and having more knowledge about these things than probably most people, I still learned some things today, and I took some pieces away with me that I didn't know. And I think some of the statistics really kind of hit home with people about just who knew that 70% of people would need some sort of care in their lifetime. That's just a really, really large group of people. So thank you so much for your time, Adele. As Adele mentioned, I'll mention it again, you can reach out to me, you can reach out to Nicole if you have any other questions about, if you want to talk about your own personal situation or just any questions related to financial planning, investments, things like that. Happy to help. That's what we're here for. So please feel free to use this as a resource.
Absolutely. And thank you all for having me. I hope that this was a good use of your lunch hour. If you were eating during this, totally fine. And I wish everybody a wonderful Passover or Easter, happy holiday. And if you're getting a long weekend and are off tomorrow, enjoy that as well. Thanks, Nicole and Emily.
Yes.
Carolyn, it was really good to see you. I haven't seen you in a long time, so it was great seeing you.
And I just want to say thanks to everyone who joined us. I know this, the financial health journey is always a challenging one. It's hard to make time and space for this. But ladies, I appreciate you taking the time, and Glenn, we're always happy to have male allies come into this conversation and space. So kudos for joining us. If you guys have ideas on future sessions, please reach out to us. We always want to be of service and make sure we're providing content that is relative to your life. So please do that. And in the meantime, I will give you guys a heads up. This year's women's event, our annual luncheon and breakfast, is going to be on June 2nd. The invitations will be going out in the next few weeks, but because you were so dedicated to your financial health, you're getting the first heads up on this information. So please go out and enjoy this beautiful day and reach out to us with any additional questions. Thank you, everybody.
Thank you. Bye, everyone.
Thank you.
Thank you so
Awesome.
much.